Today is May 23rd, 2026. This is Cindy FinTech. Welcome to today's market overview. The stock market has been on an absolute tear lately, surging nearly 20% in just the last 6 weeks. Investors went into the first quarter earnings season hoping for good news, and they got it. Corporate profits didn't just beat expectations. Projections for 2026 and 2027 were revised up by a stunning 7%, 2%, and 6.2%. A lot of people are looking at these numbers and saying, see, stock valuations aren't too high, especially with the massive AI spending boom. But before we get carried away by the hype, we need to look under the hood. There are 3 major warning signs suggesting this earnings strength might be more fragile than it looks. First, these massive profit upgrades are incredibly concentrated. Just 10 companies accounted for a whopping 70% of all the upward revisions, mostly clustered in tech, energy, and materials. Many of these businesses are benefiting from pricing power that likely won't last. Second, inflation is roaring back. Surging input costs are starting to squeeze downstream companies, but these margin headwinds aren't fully reflected in future projections yet. Third, the actual quality of these earnings is deteriorating. As the U.S. manufacturing base shifts heavily toward technology, companies are spending massive amounts of capital. This rising capital intensity means higher depreciation expenses down the road. Plus, there is a lot of income circularity happening right now among the tech giants, meaning they are essentially buying from and selling to each other, which reduces true earnings transparency. Now, don't get me wrong, there is still runway for stocks to grow. In fact, Morgan Stanley analysts see a path for equities to grind more than 10% higher, targeting an S&P 500 level of 8,300 by June 2027. But as we move forward, the actual quality of a company's earnings is going to matter a lot more than just the hype. So, what's the playbook here? It is time to think about active investing strategies, rather than just blindly riding passive index funds. Look for areas where true long-term secular growth like the Magnificent Seven might actually be on a relative sale. At the same time, it is smart to take some chips off the table. Think about reducing positions in overbought semiconductor stocks on days when they show strength, instead of chasing the most expensive, overhyped parts of the AI trade. Look for the broader diffusion of the AI build-out. Finally, don't forget the power of diversification. Balancing your tech exposure with real assets and select cyclical sectors like gold, infrastructure, and hedge funds is a vital move to protect your portfolio.